Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Okay, welcome back to the pod. Now, I've just come back from leave with my two sisters. We escaped the cold and we went across the ditch to some nice weather, nice walks. And I thought I timed it perfectly coming back because I said we'd come back on GDP Day, which is typically quite it's not the most interesting of data releases. It's the oldest of old data releases. So I thought, I'll come back, ease into it, GDP Day. But this time around, it was quite the consequential data release. It was a pretty ugly number. It's the angel of chaos just striking again, it seems like. But it was a pretty consequential number. It was a pretty ugly print and actually led to a change in call from us because of what that signals for the New Zealand economy. So why don't we start there and say, what is the new call, JK?
Well, angel of chaos, you did it once again. You came back and, the world implodes or something goes on. Anyway, so our world was a little worse than we thought. The GDP print, which you'll go through, is worse than we thought. So we've looked at that and we've gone, I can't believe we're still, in recession really, a year out from the depths of our economic turmoil last year. So it's really disappointing that we recorded this massive recession in 2024 and we've actually contracted further over the year. So on the back of that, we've said, look, whatever the Reserve Bank has done to date, it hasn't been enough to turn the economy around. And we simply need lower interest rates. So, we think they're going to cut a little further. Where are they going?
Well, first of all, they have to kind of really hit the accelerator and get to 2.5 pretty quickly.
Yeah.
So for starters, we're saying that we need a 50 basis point cut in their October meeting. That takes us to 2.5%, which we should have been there by now.
Yeah, they mucked around in May and July and then, finally turned around in August, which is too little too late.
Absolutely. And then beyond that, they need to do a bit more. So we're saying another 25 basis point cut to take us to 225 by year end, so in November. And then from there, it's a bit of a 50-50 of whether more is going to be needed, right? So we know we're going to be moving into stimulus territory. And I think we're hoping that we won't have to get to 2%, but it will really depend on how the summer plays out, what the data shows us, whether consumers are consuming, whether investment picks up from businesses, whether the housing market turns. So, but let's get to 225 and then reassess from there, I'd say.
Yeah, I think your point about needing stimulus is we need to highlight that again here. So we've had a cash rate of 5.5, which was clearly too restrictive. They've cut it to 3. Okay, that's a big move, but it's not in stimulatory territory. We think neutral is around 3, or it's within that guesstimated band. Going to 2.5 is getting you into more stimulatory settings, and then going to 2.25, it's just that one step further. So everything they've done to date has just removed the restrictiveness of policy, and what we're going to see from now on is a putting your foot on the accelerator, adding some stimulus.
Yeah, because we've been calling for 2.5 for a long time now. With that 2 years, and with that we were expecting this recovery in 2025. So that's obviously not eventuating. We've got the economy going backwards over the June quarter. So clearly we need to see more stimulus from the Reserve Bank to lower those interest rates, and then we'll get that recovery. So we've had to push down that terminal rate a little bit.
Yeah, I mean, to be frank, I'm quite disappointed that we are here a year, into what's supposed to be a recovery, and what we were talking up coming into this year. Hopefully this is the year we see some growth, and then things will get even better still in 2026. That whole story has just been kind of pushed out, right? Our forecasts just keep getting pushed out.
And it's not just you that's disappointed and frustrated. It's all the businesses that we're talking to and hearing from, because, we did kind of, not just us, but there was that sort of promise for 2025 being that year where we crawl out of the recession, and we're not. So I guess going into the GDP numbers just a little bit. So the economy contracted 0.9% over the June quarter.
That's big.
It's really big. Most forecasters, including ourselves, including the Reserve Bank, we had penciled in a 0.3% contraction. So obviously what we got was a lot uglier. There is a bit of, volatility and some seasonality issues with those quarterly moves. But then even if we kind of take a step back and look at the annual rate, our economy is still 0.6% smaller than it was this time last year, when we were, entering in this really deep recession. So that just tells you everything you need to know. And of course, on a per capita basis, things are a bit uglier as well. I think we saw a 1.1% contraction over the quarter for a per person basis. I think it's 1.3 over the year. So all of that really just sets off huge kind of alarm bells that, the economy, the policy settings that we have are not right for where the economy needs to get to. And because it was such a shocker of a number, we saw a pretty big move in markets too. We weren't the only ones to see the number and think something needs to happen here. I think there's a lot of local commentators changing their call, and markets are now pricing in also that 50 basis point rate cut in October.
Yeah, I liked how you put it, actually, when you said, we fell into a hole last year and we've actually dug ourselves deeper rather than going up. Markets have priced it in all right. So the 2-year swap rate was around 285, 286 prior. We're now at sort of 266 and heading lower, and that will continue to head south. So provided the Reserve Bank deliver rate cuts, which they'll have to, mortgage rates, business lending rates, potentially exchange rates will be lower as well on the back of this.
Do you think that the reaction in markets was a bit more outsized than typically is the case for GDP day? Mostly because it comes off the back of some comments from Governor Hawkesby at a conference just recently, where he said, we'll get to 2.5% by the end of the year, but it depends on how the economy evolves. We could get to there faster or slower. And so this GDP data is obviously supporting the case for a faster path to 2.5%. So I think that might have been the trigger for such a big reaction in swap markets when people started saying, a 50 in October. So that kind of just, because, GDP data, it's the oldest of data, and it's not the most, interesting.
But it just shows you that our starting point is much lower and messier and disappointing than we'd all thought, right? I mean, our original forecast coming into this year, we would have had growth about 1% up by now, and we've got the opposite.
Exactly.
0.6 down or 1.3 on a per capita basis. So we've been surprised on the downside considerably. And yes, the Reserve Bank has mucked around. So I think Christian Hawkesby coming out and saying 2.5 by year end, that's 2 more 25s. But now we're saying, well, actually, no, you need to do more. You need to do 75. And I think that's pretty much the consensus now, isn't it? Or close to.
Yeah.
They had, pivoted in August because they were expecting a contraction in the June quarter. The contraction we've gotten is much uglier than they expected, than anyone expected. But back in August, there were already 2 voting members that were actually already voting to cut in August by 50 basis points. So it probably also just seems very likely now that view is the consensus now. The economy is in a much worse state than they thought. And so I'm assuming, and I'm pretty sure, we'll see them pivot towards saying, okay, that 50 basis points becoming the consensus view.
Yeah. Even within this year, there's been quite a change in the Reserve Bank. So in May, there was someone who said no more cuts, right? And then in July they paused, right? And then of course things got so bad that we have to do more. It reminds me of last year, where they were hawkish at the start of 2024. They completely missed the recession that was in play, and then had to play catch up for the rate cuts. They've done it again.
very reactive to old data as well, which actually makes them quite behind the curve when this plays out. That's why we're calling, it's like toward the end of the cycle, but we're calling for bigger moves.
Yeah. I'm all for waiting and watching the data. That's fine. But I think the Reserve Bank need to be leaders rather than followers, rather than sitting there letting the economy run into a recession and then continue to run a recession and being reactive to very old data, like you say. We've been calling for 2.5 for a long time, right? It took them ages to get to that view. And now we're at a point where we're revising our path lower still.
Yeah.
I was just going to say, it's just really not what you'd expect. If we were sitting down this time last year, kind of coming out of a recession, you really would not expect to still be talking about a contraction in output, 12 months after the fact. Looking at the GDP data, it was very much broad-based weakness as well. It's not just pockets of distress in certain industries. Again, it's that broad-based weakness. And, you can use the messy overseas picture as one excuse for this. Businesses feeling a bit of restraint, but there's just been no support on domestic, conditions to see our economy grow. So it's just the green shoots we thought would come have not appeared, and probably will come, in coming months.
Yeah. And I think it's okay to say, the tariffs and all that sort of madness offshore may have paralyzed people a little bit. But the best performing part of our economy is the external bit, right? It is our exports that are getting very high prices, commodity prices. It is tourism that's bouncing back. It's the domestic stuff that's not. So, yeah, we may have had a tariff shock that may have paralyzed some people temporarily, but actually, like you say, 10 of the 16 industries that we measure in the GDP contracted.
And I think if you just look at, there was a great chart that was circulating after the GDP release. It wasn't actually one of ours, but it was, I can't remember whose it was, but it was just comparing our GDP for the June quarter compared to other countries' GDPs for the June quarters. And it just doesn't compare. I think we were the only one actually in contraction while everyone else is growing. So you can't really put it down to just the global environment. It is that domestic portion. It is broad-based, those 10 out of the 16 industries, that equates to, we had 2 out of the 3 high-level sectors in decline, so your goods producing in decline. Your primary sector, even though agriculture is doing good, your primary sector did decline over the June quarter, but it's off a relatively higher base. It was only down 0.3% overall. And then your services were flat. So you just don't have any growth really anywhere.
Yeah, and that's ongoing, right? So, I think even before the GDP number, our forecasts for the second half of the year are pretty weak as well, right? As we sort of push out that expected recovery. Yeah.
We are, this September quarter, some of the high-level indicators kind of point to a bounce back, and it looks like we'll get that. But part of it will be a technical bounce back just because you're starting from a lower base, but we just need to see more industries, developing in terms of domestic demand and domestic growth, and that's when the conditions, the summer period will be quite the good test for it, whether the consumer kind of comes back and spends a little bit more over the holiday period. If business confidence, as you were saying, Sabrina, actually translates into investment, that'll be a really telling picture, because as we were saying, we don't want to go to 2% because that signals that the economy is very weak, that it needs more support. We really need to see things turn around, and we hope that it does.
Yeah, the housing market's quite seasonal, isn't it? We like selling and buying homes in the warmer months, and we sort of take them off the market in the winter months. So the true litmus test will be, how the housing market performs after these rate cuts, and with expectations of more rate cuts. So, it'll be interesting to see how the housing market performs and how that feeds into household confidence and business confidence as well, particularly small businesses who put a home against their business lending. So it is quite an important time of year. You know, are we sort of coming into spring with confidence? I'm not sure we are. And one thing that I think shows this relative weakness is our migration stats. You know, we're losing a lot of Kiwis to Australia and the UK, and it's a game of tug of war, and we're losing. Right, our economy's weaker. It's still in contraction. If you've lost your job here, if you've lost hours here, what are you doing? You're going overseas. And a lot of businesses I speak to are saying that's happening. And it was quite interesting talking at the Master Painters conference and the Master Builders conference, and both of them were saying we train up, you know, apprentices, we get them on site, we train them for a couple of years, and bang, they're off to Australia. How frustrating is that?
Yeah, exactly. Actually, on that, you know, you're saying how you've been in a different city, like for the last 10 weeks, you've been in a different city.
I have, yeah.
And what are the other kind of insights you've picked up from businesses and investors? What else are they saying?
So there's a lot of interest out there. There's a lot of people turning up and wanting to hear what's going on, which is cool. But yeah, over the last 10 weeks, I've been somewhere. I've been in a different part of the country each week, which is quite cool, and it's a privilege. But the reaction that we're getting is one of disappointment and frustration, and you know, we all thought this year was going to be better than last year. Many businesses saying it's actually worse, which that's bad, like really bad. And their outlook into next year has been tainted because of that. And there's an election next year, which is just another complication for many businesses.
Yeah.
Amazing. God.
I was not to add,
so difficult, yeah.
not to make you, you know, sigh in more desperation, but I think we've heard on a number of occasions from different businesses that they're finding this tougher than the GFC as well. So that's just very
says
telling.
Something.
Yeah.
Right, because that was bad, GFC.
Yeah.
And
Sigh again.
And the angel of chaos induced COVID as well.
Amazing.
But you know, our job is to go, okay, what's happening now, and what is happening now, and how do we respond to it? But what's going to happen over the next few years? And I think the Reserve Bank, they've been sort of dragged into this again, kicking and screaming, but they will do the right thing. They may not have done it as clean and as nice as we would have liked to have seen. But they will do it, and I think they will get the cash rate down to wherever it needs to be. It's just taking longer. So we're saying a 50 in October, so that's an acceleration. That's a recognition that the economy still in recession, needs stimulus. Bang, you're down at 2.5. Then you've got November. October's an NPR too, right? Like it's not a full statement and whatever. Then you get the full statement in November, and we're saying they'll go again to 2.25, and then it's a discussion, you know, do we go to 2 and wait and see some of the data, I guess. But, okay, they've done that, right? What are we then thinking for next year? I mean, I think a cash rate of 2.25 is going to bite and sort of and stimulate, like you say.
Yeah. So do you want to start talking about rate hikes? Surely not yet.
No, not yet.
No. We know that they will be there.
We need to find the bottom.
Yeah, we need to find the bottom.
Yeah. Hopefully they cut so much that we do need to have rate hikes in 2026, 27. That would be great if they did that, and it created the environment for a proper recovery next year. That would be fantastic. I would love to call for rate hikes. Yeah, I know you said the opposite, right? We don't want. Sounds like we want rate cuts because we're so I don't know what the word is. Dark.
One thing I was gonna say, bringing it back to how we've come to this conclusion with, you know, the weakness in the economy from the GDP numbers, you know, putting us in a position where we've had to change our call. For those that might be listening and thinking, well, the Reserve Bank, they're targeting inflation, not growth. But it's always important to think about how, such a weaker growth outlook and growth spot that we're in right now does, mean and imply a deeper negative output gap, which then, weighs on domestic prices and does put downward pressures on prices. So in that vein, even though we're seeing a recent acceleration in inflation at the moment, come this time next year, we're actually seeing inflation back down to 2%, potentially even shooting below, especially now that we know that that output gap is a lot more negative.
So what is a more negative output gap? What does that mean?
Mary Jo? I've got uni brain right now, and I can only think of the textbook answer.
Yeah, exactly. You should know.
I should explain it to people.
We actually did. No, didn't we do an episode on this? What the output gap is?
Oh, did we? Okay,
I think we might have.
I think we talked about it in our Outlook note.
But basically, it just means that our economy is a lot. The way that the Reserve Bank will read this is that the output gap, where our economy is tracking compared to our potential without igniting any inflation, we're tracking well below that. So actually, it's deflationary. So they'll look at this old data and basically say that we've got a much weaker starting point, which signals weaker domestic demand, and that domestic demand will, as you say, put some downward pressure on domestic prices, and you get this effect where inflation could potentially be below 2%, which is something we've flagged for a while, and the reason why we need more stimulus to generate that, inflation, because, getting back to 2% is your main goal. Yeah. And when you've got a weak growth outlook, it obviously puts that under pressure. So,
well, we had inflation dropping to 1.8, didn't we, in the second half of next year?
About there, yeah.
Yeah.
Next year.
And like you said this morning, these numbers will put downside risk to that 1.8 forecast, right? So, the Reserve Bank will be thinking exactly along those lines, like you say. So reduce growth, reduce inflation.
Need more stimulus.
More need for stimulus.
Yeah, exactly.
Because you just mentioned the master painters, master builders, I think you actually shared with me a really interesting anecdote about what the master painters are actually seeing across the economy and how they kind of get a read as an indicator almost. Yeah,
it was kind of cool. One of the business owners was saying, look, paint tends to follow its way around the economy, and at the moment they've still got plenty of work. The good painters have work, whereas in his words, the cowboys have kind of been sort of kicked out, which is not necessarily a bad thing. But one thing he was saying was they are actually doing a lot of work on the farms, so a lot of maintenance that hasn't been done for a long time, painting the farmhouse, painting this, painting that. So there is activity on the farm, but not so much outside of it. And one of the major paint brands were telling me that of all the litres that they produce a year, like 15 million litres, a third of it goes to new build, and that's the softest bit at the moment. But the other 2/3 are going into these areas, particularly on the farms. So, yeah, it is kind of. I love these sorts of little anecdotes that you get here and there. So they're not doing so bad, but there's clear weaknesses and strengths around the economy, which kind of marries in with what we're seeing in the data.
Yeah. Is this also the place where you once told us that painters or buying paint is a really good indicator or forward indicator of housing market turnover, because people will start to buy paint to, when they got a new house, they have to repaint the walls or whatever, and they haven't seen that just yet? Yeah.
Not yet. Okay. Yeah. So again, there's so many different I guess businesses that are tapped in, like the urgent courier guy, getting a good handle on.
They see it first.
I feel like we almost need like a niche indicator index where you have like paint and you've got like courier, so just really random things that actually have a really strong growth, or like little bit of insight, but missing in the market. That could be our creation, the paint index.
The paint index. Oh, I like it.
master painters. Let us know if you want to collab.
Yeah, let's do it.
Okay, I think that's it for this episode. You know, there's obviously we're in a pretty tricky position, or we have been in a tricky position, but we know from the Reserve Bank that they're willing to do the right thing, and if it means having to push the cash rate below 2.5%, I think we've got confidence that they'll do that to get the economy going and growing into next year. So hopefully we don't get to 2%, but that's clearly a discussion that needs to be had if we don't see things turning around. But you know, getting the cash rate below and firmly in that stimulatory territory hopefully starts to ignite some activity from businesses and consumers. So we'll be watching the data to see how that all unfolds. And that's it from this episode. Tune in next time.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.